Right now, millions of retirees are walking straight into a massive tax trap simply because the IRS changed the required minimum distribution age to 73, but secretly left the most powerful tax loophole locked at exactly age 70 and a half. If you wait until age 73 to start planning, you will permanently lose out on a perfectly legal strategy that can wipe out your Medicare surcharges, protect your Social Security from taxation, and drain your IRA tax-free. The confusion out there is completely understandable. For decades, age 70 and a half was the undisputed magic number for retirement. It was the exact moment the IRS forced you to start pulling money out of your retirement accounts and paying taxes on it. Then, recent legislation, first the Secure Act and then Secure 2.0, pushed that mandatory withdrawal age to 72, then 73, and it is eventually heading to 75. Almost overnight, everyone stopped worrying about age 70 and a half. But the IRS quietly kept 7 incredibly powerful tax strategies anchored to that exact half birthday. I have seen countless hardworking people surrender thousands of dollars to taxes they legally did not owe simply because they did not know these rules still exist in 2026. Today, we are going to walk through the 7 specific things the IRS lets you do after 70 and a half that most retirees never use. I am going to show you exactly how they work, how to stack them together, and how to protect your life savings from unnecessary taxation. We are going to start with a strategy that can immediately put cash back in your pocket by lowering your healthcare costs. And I have saved the absolute most powerful, counterintuitive estate planning secret for last. Number 1, the IRMAA assassin. Protecting your Medicare premiums. Let us begin with something that catches almost every retiree completely off guard. Medicare Part B and Part D surcharges. This is officially known as IRMAA, which stands for the Income-Related Monthly Adjustment Amount. When you enter your 70s, your income directly dictates how much you pay for healthcare. If your income crosses certain IRS thresholds by even a single dollar, your Medicare premiums can instantly double or triple for the entire year. Here is the setup. You have spent decades diligently saving into a traditional IRA or 401k. That money has grown tax-deferred, which is fantastic while you are working. But now that you are retired, every dollar you pull out of that account to pay for your living expenses, or eventually to satisfy your required minimum distributions, is treated as ordinary income. This spikes your adjusted gross income, or AGI. The tension builds because the IRS looks at your AGI to determine your Medicare premiums. If your IRA withdrawals push your income over the first IRMAA threshold, you do not just pay a little bit more in taxes. You are hit with a cliff penalty. One extra dollar of income can cost you thousands of dollars in added Medicare premiums. It feels like a punishment for being a good saver. This brings us to the payoff, the Qualified Charitable Distribution, or QCD. At exactly age 70 and a half, regardless of the new RMD age of 73, you are legally allowed to move money directly from your traditional IRA to a qualified charity. You can transfer up to $105,000 per year, adjusted for inflation. The absolute magic of this strategy is that this money never touches your tax return. It does not show up as adjusted gross income. Imagine a retiree named Robert. Robert is 71 years old and wants to give $10,000 this year to his local food bank. If Robert pulls $10,000 out of his IRA, puts it in his checking account, and then writes a check to the charity, that $10,000 is added to his AGI. That spike in income pushes him over the IRMAA limit, and suddenly his Medicare premiums skyrocket. But if Robert uses a QCD, the money goes straight from his IRA custodian to the food bank. His AGI stays exactly the same as if he never touched the money. He avoids the Medicare surcharge entirely. Did you know that over 60% of retirees paying IRMA surcharges are doing so completely unnecessarily? They have charitable intent and they have IRA funds, but because they do not use the 70 and a half QCD rule, they are needlessly inflating their income and paying stealth taxes on their healthcare. 2. The Social Security Tax Rescue. If there is one tax that makes retirees angrier than any other, it is the tax on Social Security benefits. You paid into the system with after-tax dollars for your entire working life, and now the government wants to tax you again when they hand it back. The setup here revolves around a deeply confusing formula the IRS uses called provisional income. Your provisional income is what determines whether your Social Security benefits are tax-free, 50% taxable, or up to 85% taxable. To calculate it, the IRS takes half of your Social Security benefit, adds it to your ordinary income, adds your capital gains, and even includes non-taxable municipal bond interest. Here is where the tension lies for anyone over 70 and a half. You might be trying to hold off on touching your IRA until you absolutely have to at age 73. But maybe you need a little extra cash, or maybe you want to start gifting money to your church or alma mater. The moment you take a standard distribution from your traditional IRA, you are pouring gasoline on your provisional income calculation. For a married couple filing jointly, if your provisional income is between $32,000 and $44,000, up to 50% of your Social Security is taxable. If it crosses $44,000, up to 85% becomes taxable. Let me be clear, $44,000 is not a lot of money in 2026. Almost any meaningful IRA withdrawal is going to trigger the 85% taxation tier. You are effectively paying a double tax. You pay ordinary income tax on the IRA withdrawal, and that withdrawal forces you to pay tax on your Social Security. The payoff is once again unlocked at 70 and a half. By utilizing the QCD for any charitable giving, you completely bypass the provisional income formula. Because a QCD is excluded from your adjusted gross income, it is also excluded from your provisional income. You can move tens of thousands of dollars out of your IRA to support causes you care about, and the IRS acts like it never happened when calculating your Social Security taxes. Think about the profound difference this makes. If you withdraw $20,000 normally to give to charity, that $20,000 could pull 85% of your Social Security benefits into the taxable realm, costing you thousands in unnecessary taxes. If you make that exact same $20,000 transfer via a QCD, your Social Security remains protected. You get to be generous without being penalized by the federal government. Number 3, the double dip deduction, the standard deduction loophole. Now we need to talk about how the tax code actually works for the average person today, because it has changed drastically over the last several years. The setup is straightforward. Whenever you file your taxes, you are allowed to reduce your income by either taking the standard deduction or itemizing your deductions. Because recent tax laws dramatically increased the standard deduction and added a substantial extra deduction for being over age 65, the standard deduction for a married couple in 2026 is exceptionally high. This creates a massive tension. Because the standard deduction is so large, nearly 90% of taxpayers no longer itemize. If you do not itemize, you get absolutely zero tax benefit for writing a check to your favorite charity. Let me repeat that. If you just write a check from your bank account to a charity and you take the standard deduction, the IRS gives you zero tax relief for that generosity. You are giving away after-tax dollars. You paid tax on that money when you earned it, and you get no deduction when you give it away. But at age 70 and a half, the IRS hands you the ultimate payoff, the ability to double dip. When you execute a qualified charitable distribution, the money leaves your IRA without ever being taxed. It is completely tax-free to the charity. Because it never enters your taxable income, it is functionally equivalent to getting a massive tax deduction. But here's the brilliant part. You still get to claim the full inflated standard deduction on your tax return. Let us look at how powerful this is. Suppose your standard deduction is $32,000. You also want to give $15,000 to your church this year. If you take money from your checking account, you get your $32,000 standard deduction, and that is it. The $15,000 gift gives you no extra tax benefit. If you use a QCD from your IRA at age 70 and a half, you still get your full $32,000 standard deduction to shield your other income. Plus, you successfully avoided paying taxes on the $15,000 you pulled from your IRA. You have effectively shielded $47,000 of wealth from the IRS in a single year. Why are so many retirees missing this? Because their CPAs or tax software only ask, "Did you make any charitable contributions?" They do not proactively tell you, "Hey, you are 70 and a half now. Stop writing checks from your bank account and start using your IRA." You have to be the one to initiate this process. 4. The pre-RMD deflation strategy. Let us shift our focus to the future. Specifically, the ticking time bomb that is your required minimum distribution at age 73. The setup is a common psychological trap. Because the IRS pushed the RMD age back to 73, most retirees think they have been given a gift. They think, great, I can just let my traditional IRA grow tax-deferred for a few more years. I will live off my taxable accounts and let the IRA compound. Here is the tension, and it is a severe one. We call this the tax torpedo. By allowing your IRA to grow completely unchecked until age 73, you are building a massive tax liability. When age 73 finally arrives, the IRS forces you to withdraw a percentage of that inflated balance every single year, whether you need the money or not. Because the balance has grown so large, your mandatory withdrawals will be massive. These forced distributions stack on top of your Social Security, your pension, and your investment income. Suddenly, you are catapulted into the 24%, 32%, or even higher marginal tax brackets. You lose control of your income. Have you actually sat down and calculated what your RMD will be at age 73? If you have a $1 million IRA, your first RMD is going to be roughly $37,000. By the time you are 80, if the account continues to grow, that forced withdrawal could be $60,000 or $70,000 a year. The payoff is the pre-RMD deflation strategy, which you can begin exactly at age 70 and a half. Instead of waiting for the balloon to pop at 73, you can use QCDs to intentionally deflate the size of your traditional IRA before the government forces your hand. Every single dollar you transfer to charity via a QCD between the ages of 70 and a half and 73 is a dollar that permanently escapes the RMD calculation. You are systematically shrinking the taxable foundation of your retirement accounts. By doing this proactively, when you finally do reach age 73, the balance of your IRA is significantly lower. Your mandatory withdrawals are smaller. You keep your taxable income in the lower brackets, you avoid triggering the IRMA and Medicare surcharges we discussed earlier, and you retain control over your financial life. It requires a shift in mindset. You must stop viewing 73 as the start line for IRA planning and recognize that 70 and a half is your true window of opportunity to take the air out of the tax balloon. 5. The widow's tax trap avoidance. This next point is perhaps the most emotionally difficult to discuss, but as someone trying to protect you and your family, it is absolutely critical. We need to talk about what happens when one spouse passes away. The setup is a reality we all must face. Most married couples have the bulk of their savings in traditional, pre-tax retirement accounts. While both spouses are living, they file their taxes as married filing jointly. The tax brackets for married couples are wide and generous. It takes a significant amount of income to push a married couple into the higher tax brackets. The tension hits the moment one spouse passes away. The surviving spouse typically inherits the deceased spouse's IRA. Now the survivor has the exact same amount of money in the bank. They likely have very similar living expenses, especially regarding home maintenance and property taxes. But when tax time comes, the surviving spouse must now file as a single taxpayer. The tax brackets for single filers are brutally compressed. The exact same income that kept a married couple safely in the 12% or 22% bracket will easily force a single widow or widower into the 24% or 32% bracket. This is known as the widow's penalty. It is a devastating stealth tax that strikes people during the most vulnerable period of their lives. Furthermore, because the survivor now holds both IRAs, their required minimum distributions at age 73 will be massive, all taxed at those aggressive single filer rates. The payoff relies on aggressive use of the 70 and a half rules while both spouses are still healthy. If you wait until age 73, you have less time to manage this risk. But starting at 70 and a half, a married couple can use QCDs to aggressively draw down their traditional IRA balances. If you are going to support charities, tithe to your church, or fund scholarships, you must do it exclusively from your pre-tax IRAs while you still have the benefit of the married filing jointly tax brackets. By strategically draining the taxable IRAs early, you can afford to leave your tax-free Roth IRAs and your taxable brokerage accounts, which receive a step-up in basis, untouched. You are intentionally building a protective shield for the surviving spouse. When the inevitable happens, the surviving spouse is left with a much smaller traditional IRA balance. Their forced RMDs will be manageable, keeping them safely out of the punitive single-filer tax brackets, and they will have tax-free Roth money to draw on if they need extra income. Do not leave a ticking tax bomb for your spouse. Use the 70.5 rules to clean up the mess while you are both still here to do it together. In just a moment, I'm going to share the seventh and final strategy. It is arguably the most powerful wealth transfer secret the IRS allows, and it completely rewrites the rules on how you pass money to your children. But before we get to that grand payoff, we need to talk about a brand new law that almost no one is talking about. 6. The lifetime income loophole, charitable gift annuities. One of the biggest reasons people hesitate to use their IRA for charity is fear. The setup is natural human psychology. You have worked 40 years to build your nest egg. You want to be generous, but you are terrified of running out of money. You think, if I give this money away to a charity, it is gone forever. What if I need that money later for a nursing home or medical care? This tension prevents retirees from taking advantage of any of the strategies we have discussed so far. They hoard the IRA out of a protective instinct, only to get hammered by the taxes we just covered. But thanks to a provision in the Secure 2.0 Act, there is an incredible payoff that solves this exact problem. It is a one-time loophole available to you once you reach age 70.5. The IRS now allows you to make a one-time qualified charitable distribution of up to $53,000 adjusted for inflation directly from your IRA to a split interest entity. The most common and powerful version of this is a charitable gift annuity. Here is how this counterintuitive strategy works. You transfer $53,000 from your IRA to a charity. The money leaves your account tax-free, satisfying the QCD rules. It does not count as income, it does not trigger IRMAA, and it lowers your future RMDs. But instead of the charity just taking the money and saying thank you, they enter into a legal contract with you. They agree to pay you a guaranteed fixed income stream for the rest of your life. Let that sink in. You are moving money out of your highly taxed IRA, giving it to a charity, and in return, you are buying yourself a lifetime pension. If you wait until you are 75 or 80 to do this, the payout rate is higher, but you lose years of tax protection. By acting near the age 70.5 threshold, you immediately eliminate a chunk of your taxable IRA while securing a predictable cash flow. When you eventually pass away, whatever is left of that $53,000 stays with the charity to support their mission. It is the ultimate win-win. You satisfy your desire to support a good cause, you drastically lower your tax burden, and you completely eliminate the fear of giving away money you might need, because that money is now paying you a salary every single year until you die. 7. The grand payoff, the anti-tax estate transfer. We have finally arrived at the most powerful strategy of all. If you only remember one thing from this entire presentation, let it be this. This is about your legacy, your children, and keeping your wealth out of the hands of the government. The setup begins with a catastrophic change the IRS made a few years ago. It used to be that when you passed away and left a traditional IRA to your children, they could stretch the mandatory tax withdrawals over their entire lifetime. They could take tiny amounts out each year, keeping the taxes incredibly low, while the rest of the account continued to grow. The Secure Act violently killed the stretch IRA. Here is the tension your family faces right now. Under the current rules, when your adult children inherit your traditional IRA, they are legally required to completely empty the account within 10 years of your death. Think about the timing of this. When you pass away, your children will likely be in their 40s, 50s, or 60s. These are their peak earning years. They are already in the highest tax brackets of their lives. Suddenly, they are forced to drain your massive traditional IRA over a short 10-year window, stacking all of that inherited taxable income right on top of their own salaries. Depending on the state they live in, your children could easily lose 40% or more of your hard-earned life savings to federal and state taxes. It is a wealth destruction event. You spent your whole life saving, denying yourself luxuries, only for the IRS to confiscate nearly half of it simply because of the vehicle it was stored in. The payoff is what I call the anti-tax estate transfer, and it relies entirely on pivoting your strategy the moment you turn 70.5. Most retirees have charitable intent written into their wills. Their estate plan says, When I die, give $100,000 to the university and divide the rest equally among my children. If you wait until you die to give to charity, you are making a fatal tax error. Starting at 70 and a half, you must completely rewrite your estate plan. You should execute all of your charitable giving while you are alive, using qualified charitable distributions directly from your traditional IRA. Do not wait for your will to do it. Every dollar you give to charity via a QCD is a highly taxed dollar that you are permanently removing from your estate. By fulfilling your charitable goals with your pre-tax IRA while you are alive, you are intentionally preserving your other far superior assets for your children. You leave your children the Roth IRA, which they can inherit completely tax-free. You leave them the taxable brokerage accounts and the real estate, which receive a step-up in basis upon your death, meaning they can sell those assets and pay absolutely zero capital gains tax. You are performing a massive tax arbitrage. You are giving the worst, most heavily taxed asset to a tax-exempt charity using the 70 and a half QCD rule. And you are saving the absolute best tax-free assets for your family. Over a 10-year period, this simple shift in sequencing can transfer hundreds of thousands of dollars from the IRS directly into the pockets of your children and grandchildren. It is the ultimate act of financial protection. Summary. To protect your retirement, you must look past the noise. First, do not wait until age 73 to start planning. Age 70 and a half is your true window of opportunity to take action. Second, remember that the qualified charitable distribution is your ultimate weapon to fight off IRMAA Medicare surcharges and protect your Social Security from double taxation. Third, you can absolutely secure lifetime income while shrinking your taxable estate through a charitable gift annuity. And finally, intentionally deflate your traditional IRA now to protect your surviving spouse from the widow's penalty and to save your children from the devastating 10-year liquidation rule. You work too hard for your money to let a misunderstanding of the tax code siphon it away in your final chapters. I know this is a massive amount of information to process, and every single person's financial situation is totally unique. I want to hear how these rules are impacting you right now. Scroll down and comment your experience with IRA withdrawals, or let me know which of these 7 strategies you plan to use this year.